Ladies and gentlemen, brace yourselves for another economic nightmare brought to you by none other than the Federal Reserve, a central bank that continues to weave fiction while the real economy teeters on the edge of collapse. This time, we have the president of the Federal Reserve Bank of Atlanta, Raphael Bostic, once again articulating how the central bank must be patient in getting inflation back to 2%. But the question here is, does any of this speak to common sense, or are we being led further into an economic black hole? Bostic insists there's no rush to get interest rates to the so-called neutral level, estimated to be between 3% and 3.5%. Neutral? Neutral for whom? Certainly not for workers who are seeing wage growth lag far behind the price of their groceries, nor for homebuyers squeezed by mortgage rates inching closer to 8%. Yet Mr. Bostic says inflation will, miraculously, fall to 2% by the end of 2024, as if economic reality adheres to the soft-spoken projections of a central banker behind the safety of a microphone. Let's decipher what the Federal Reserve is attempting to do here. Inflation, according to their proclamations, is public enemy number one. And the way to combat inflation, they suggest, is to keep borrowing costs high, fight the fire with fire. This has led to an ongoing series of rate hikes, ultimately sending interest rates soaring to the highest levels since the 2008 financial crisis. But here's where things get impractically theoretical. According to Bostic, the economy can absorb aggressive rate hikes, and he doesn't foresee a recession in his forecasts. Well, sure, when you're looking at the economy from inside a central bank office rather than from Main Street, you might come to such conclusions. But the lived experiences of many Americans seem lost in these policy statements. People are facing higher borrowing costs, while wages for the average Joe and Jane are barely keeping pace with inflation. Let's not even talk about the housing market catastrophe this policy is brewing. With mortgage rates exceeding 7% to 8%, potential homeowners are now watching their dreams slide out of reach. The real estate market is freezing, but not because of any freeze in demand. People still need housing, but rather because people simply can't afford to buy. The question of whether inflation is transitory might have been popularized by central bank officials, but anyone navigating the realities of this housing crisis could easily conclude that financial pain is becoming quite permanent. We hear it all the time, the magical 2% inflation target. It has become the sacred cow for central bankers. While this isn't to say that price stability isn't a worthy goal, this dogmatic obsession with an arbitrary 2% figure might be leading to even more destructive consequences than anticipated. Do we even have evidence that keeping inflation at 2% fosters long-term economic prosperity? Historically, before consumer price indexes and modern monetary theory, economies fluctuated naturally with far less central bank interference. Inflation hovered around much higher levels during periods of rapid industrial innovation, yet post-World War II, millions climbed out of poverty into middle-class prosperity. Is there something inherently wrong with a little inflation in moderation? Central banks have no credible answer. Their main justification remains keeping inflation low, because it's what we've always done. More perplexing still is the unwavering belief that getting inflation back to 2% involves increasing unemployment, despite most economists recognizing the Phillips curve. The alleged trade-off between inflation and unemployment is an oversimplified and outdated relic. Nevertheless, central bankers like Bostic insist we must endure jacked-up borrowing costs, squeezing businesses, consumers, and workers alike, all to see inflation tamed. Meanwhile, major corporations continue raising prices with impunity while passing higher costs onto consumers in an environment where demand has not substantially subsided. Could it be that inflation is possibly coming from somewhere beyond the labor market or consumers' ability to spend? Corporate profiteering in sectors such as energy, basic goods, and real estate isn't being touched or even acknowledged by these policymakers. Mr. Bostic also argued that despite aggressive rate hikes, the labor market remains robust. Now, I've heard this one before: strong labor markets, high employment, and so forth until things begin cracking slowly and then all at once. The inconvenient truth here is that robust doesn't mean secure. The U3 national unemployment rate may look satisfying to read in official government reports, but how about the millions of Americans working multiple part-time gigs just to survive? What about the surge in temporary jobs or gig economy work that obscures the reality of underemployment? Bostic and his colleagues are probably right that the labor market may appear strong for a while longer. But this brief phase of worker demand is not an economic lifeboat. If anything, it's a delayed precursor to a ticking time bomb, a looming downturn caused by skyrocketing debt costs, an outdated industrial policy, and crushing economic uncertainty. Combine falling wages with growing job insecurity for the average worker, and you've got a disaster waiting to happen as soon as consumer savings start drying up. And as Bostic hinted, consumers are spending through their savings. Household debt is at historic highs. This story doesn't have a happy ending. Western economies are bleeding competent workers who are seeking better opportunities in underappreciated sectors, or worse, burning out completely due to economic pressures. Speaking of squeezing, are we going to ignore the albatross in the room, the suffocating housing crisis? I don't know how much more blatant the failure can be, but rates for mortgages have eclipsed 7% multiple times this year, levels not seen in 2 decades. Combined with sky-high home prices, it's becoming virtually impossible for young families to even contemplate buying a house. Millennials, already battered by a 2008 financial crisis in their formative years, are now aging into their 40s with some of the lowest homeownership rates ever recorded. Yet Mr. Bostic and his fellow policymakers remain more focused on fighting inflation, largely driven by systemic factors like supply chain trauma and geopolitical tensions, rather than recognizing the more imminent risk created by crushing home loan costs. Regulatory overreach has fueled speculative bubbles in housing markets, pricing real people out of real homes while investors scoop properties en masse to sit on for profit. This creates a crisis not just for prospective homebuyers but cascades into rental markets, pushing prices even higher, since property owners are increasingly incentivized to rent rather than sell. It's a structural issue that interest rate hikes cannot solve. Unfortunately, tightening credit from high rates is shrinking home construction, discouraging future housing developments, and making it virtually impossible for prospective buyers. Now, if anyone thinks the pain of high interest rates stops at consumers, let's reflect for a moment on corporate America. For over a decade, low borrowing costs kept companies flush with cheap debt. Corporate borrowing exploded, and many businesses took advantage by funding aggressive expansions, stock buybacks, and speculative ventures. But at what cost? With interest rates now sitting at restrictive levels for over a year, businesses are facing the reality of refinancing their debt at much higher costs. Worse yet, sectors like commercial real estate are headed for near-certain disaster, with vacancies climbing and companies unable to hold up under the weight of higher borrowing costs. Many see the tech downturn already striking. Major tech firms, such as Meta and Google, have announced rounds of layoffs and are being forced to rein in their ambitious projects. Credit is becoming more constrained, startups can't find funding as easily, and consumer-facing businesses face declining spending power as inflation chews away at disposable income. The banking sector isn't all too secure either. Banks over-leveraged in a heyday of low rates may soon scramble to adjust their balance sheets, and we all remember how well this risk management went during 2008. Finally, it's necessary to talk about the global impact. The Federal Reserve seems to forget that the US doesn't exist in a vacuum. The aggressive rate hikes have strengthened the dollar, wreaking absolute havoc on emerging markets. You see, global debt is often denominated in dollars, which means when the Fed relentlessly hikes rates, borrowing costs explode not just within US borders but throughout the entire global financial system. Countries like Argentina, Turkey, and Pakistan, already struggling with unstable currencies and inflation, are now finding it even harder to service their debt, pushing these countries further toward insolvency or default. Foreign entities reliant on cheaper debt will now face harsh budgeting realities, and their agitation could bring even greater geopolitical risks to the global economy. When dollar-denominated loans overseas become unaffordable, US exports also suffer, corporate margins shrink, and suddenly those hardy-looking job reports no longer reflect the complexities shaping global trade under tightening monetary conditions. Mark my words, folks, Bostic and his Federal Reserve colleagues are selling you an illusion. They believe they can control inflation, employment, housing, and the entire economy with minor tweaks to the interest rate dial, all under the false pretense of a command-and-control academic idealism. History has shown us repeatedly that the tighter you attempt to control the economy, the more out of control it spins. Financial burnouts, housing meltdowns, labor market cracks, all under the misguided assumption that an overzealous focus on monetary tightening will smooth out destructive economic forces. But here's the truth: the economy is far too complex and intertwined, both domestically and globally, for simplistic central bank interventions to solve structural problems.